All right. Okay, I think we'll get started and people can come on in as I do a little bit of housekeeping here to start us off. But hello, everyone. Welcome to our second session of the 2021-2022 Learning Exchange Series. I'm your host today, Kylie Clay. I'm the Associate Director for the Forest, Carbon, and Climate Program at Michigan State University. We are pleased to lead the Learning Exchange Series in partnership with the Forest Climate Working Group. The Forest Climate Working Group is a diverse group of forest interests with over 60 members, including landowners, industry actors, conservationists, academia, those active in carbon markets. With particular interest today, I imagine. The group has worked together for more than a decade to advocate for state and federal policies that work to ensure sustainable forest use and prevention of land use change. We are delighted to announce the full year's lineup of speakers here on the screen. It's a bit small to read. We'll go ahead and drop the link in the webpage in a little bit. Sorry, the webpage in the chat in a little bit so you can check out all the speakers in more detail. This year, we have three major thematic bins. So the first bin is voluntary carbon markets, part of today's presentation. The second is changing landscapes of climate and forests, and emerging science. So for today's presentation, I'd like to introduce Erik Ringvold, Senior Engagement Manager at McKinsey. Erik will give a presentation titled Taskforce on Scaling Voluntary Carbon Markets, Approach to Scaling a High Integrity Carbon Market. Today's session will kick off the second of the three presentations on voluntary carbon markets, focusing in particular on the Taskforce approach to identifying and overcoming barriers to scaling carbon markets. Couldn't be more topical and important considering ongoing discussions at COP26 here. We're very excited to begin today, but before we do, we'd like to share just a couple of few details here. First, to automatically receive registration details and information regarding upcoming webinars, please email forestc@msu.edu to join our mailing list. This session is being recorded and will be posted on the web, along with any supplemental resources, such as the presentation slides, in the next week or so. If you've registered for this webinar, you'll receive an email letting you know when and where to find those materials. This session will be followed by a Q&A, as usual. So on the Zoom interface, you'll see the word chat with a little drop-down triangle next to it. There you can type in any questions or at any point during the presentation or Q&A, and we'll compile and present those questions to Erik at the end of his presentation. So if you're calling in on the phone but can email, you can also send questions directly to forestc@msu.edu. Last here is attendees are qualified to receive one CFE, continuing education credit from SAF. This will automatically be communicated to SAF and you'll receive credit if you've registered with your information on your SAF account. If you have any questions about this, please reach out to us again at forestc@msu.edu. And that's our last bit of housekeeping here. So with that, Erik, please go ahead and steal the screen and you may begin. Thank you.
Thank you so much, Kylie, and thank you all for having me here today. Excited to share a bit, and also looking forward to the discussion we're going to have afterwards. So as Kylie said, what I will be talking about today is the work that I've been a part of for the last year on the Taskforce on Scaling Voluntary Carbon Markets, where the aim has been to scale up a high integrity carbon market to make a real dent against the 1.5 degree Paris ambition. And if you're wondering why I'm wearing so many scarves and jackets, it's because I'm sitting in Glasgow and I'm absolutely freezing up here. But also very excited, to, of course, with all the developments in the last days. So what I'll be talking about is three things. First, a recap of voluntary carbon market trends and pain points, and sort of the reason for existence in the first place of the task force. And then I'll talk a little bit about the task force itself, what that has been up to in the past year, and then I'm going to finish up with what the next steps look like really make the vision of this a reality. But I think the best place to start is kind of bringing us back to the global carbon budget and where we need to be by 2050. Right, we have a tremendously difficult decarbonization curve to follow, and at the same time, we're going to need to scale removals by orders of magnitude beyond what is imaginable or doable today in order to get us to net zero by 2050. And voluntary carbon markets is not the solution, but it certainly can help. It can help accelerate the pace of the yellow decarbonization, and it can certainly help providing an actual price signal for the dark blue removals, which are so critical in order to, at the end, get us to our goal. But carbon markets are starting from a very, very small point today. We're talking 0.1 gigatons overall, so kind of miles away from 100x smaller than any compliance markets, and obviously not for that same reason does not have a huge climate impact today, but it's growing fast. It's been growing at 30% for the past few years, and it's on track for even faster growth, probably around 50% for the year ahead. Why is this happening? I think we're seeing tremendous momentum across the value chain of voluntary carbon markets. We have a demand signal that is strengthening month by month as we've been progressing through our work. More and more companies, more and more states coming online with targets. Totally, like, they're certainly not good enough yet and need to be way more specific and concrete, but they're every day growing. And what I have on this slide is anyways now outdated since the past day. As you may have seen, we're now at 80% of global GDP covered by net zero targets as of a couple of days ago, which is great, and it obviously creates a large demand signal for voluntary carbon markets, which are very likely part of the solution for all those companies and countries pledging to go to net zero. When we started off a year ago, the market was extremely underdeveloped when it came to intermediaries and financial services. And here as well, we're seeing a host of innovation that is driving the market forward. So we have things like IHS Markit, which are driving transparency and standardization through a meta registry, which links up many of the underlying different standard setters of the market. There's now daily price assessments, and there are exchanges that are entering the market that are really helping to make trading more efficient and more at scale as well. On the supply side, we continue to see great innovation. We see particular players that are entering into new technologies such as satellite, drone, IoT sensors, AI, DLT to get this market, to get the digital monitoring, reporting, and verification to the next level for this market going forward. We're also starting to see some big deals shaping up for that crucial removal scale up that I was talking about at the beginning as well. But there's still problems to solve. The market today remains very, very fragmented. I think probably the most critical fragmentation happens in this issuance column, where you actually have over 20 different standard setters that are trying to set the rules for this market. And for every one of these 20, there are hundreds of underlying methodologies for various forestry credits, for various energy efficiency, renewables, cook stoves, you name it. So it's an extremely difficult space for any buyer to navigate, to understand, what exactly is high quality, what should I be buying, which standard setter should I go to, what kind of project type should I be getting. It is very difficult for buyer to navigate that space. We ask them what they think, and the number one fear of buyers is indeed on the credit side itself, and just a very big fear that they're buying stuff that is not of high environmental quality. When we talk to large buyers, they're all worried that they're going to be the next company to be put on the front page of Bloomberg, with a story of how their carbon credits that they bought in good faith actually delivered no climate impact, or maybe even worse, had some negative side effects on local populations, etc. I think just other pain points is a real sort of risk or fear or not understanding of how double counting or double claiming works in the space, and also just a limited understanding of they just find it hard to navigate that complex ecosystem that I just showed you. So that led to the setup of the task force on scaling voluntary carbon markets. And I think the premise a year and a half ago was that there was real room for a private sector body to get into the space and set some clarity all across or try and set some clarity all across the value chain, get all the different pieces of the value chain working together to really achieve a step change in this market and help it achieve it and help it realize its great potential to actually have a meaningful impact towards 1.5 degree Paris ambition. The task force was initiated. The idea came from Mark Carney, who got this idea going. He got Bill Winters, the CEO of Standard Chartered, with him to chair this initiative. The Institute of International Finance to be the host body for this initiative. A former SEC commissioner and at Nazareth to serve as an operating lead, and with McKinsey providing advisory and knowledge support to this effort throughout. And slowly and surely, we built up a set of over 250 organizations and 400 people who are all part of this initiative, and keen to make a difference in seeing how the private sector actually can do this together. We released the first, so with this group we started working on what needs to happen, and we came up with sort of a set of 20 main things, which was released at Davos, and we were lucky to have Bill Gates with us presenting that. We realized at that stage that there is probably at least 3 things that this joint group of 250 people could do together, and those things were one, figuring out how do you make all of this permanent, and how do you set up a permanent body that can oversee all of this stuff. 2, given the huge fragmentation in the standards, new meta standard that would sit on top of all of the existing standard setters, and providing a layer of quality assurance as well as standardization, which really allows for the 2 ambitions of increasing integrity and standardization for scale at once. And just now, at the time of COP, we've sort of fully transitioned from the Task Force on Scaling Voluntary Carbon Markets into a new governance body, permanent body, which I'll tell you about a little bit later. Because I wanted to first just explain this work that the TSVCM has been doing. And I think step 1, and also kind of part of also why I'm here today, right, is I think it's been very important to get the right narrative out there in the market. There's for very good reason, very differing views on if voluntary carbon markets are a good thing or not. And I think, at least I personally believe that done right, done in the way that we're trying to lay it out, it can actually have a huge impact. And so sort of driving that message across the market has been key. Second, this thing cannot exist as an initiative forever. So landing on permanent governance was absolutely crucial to get this going. In order to obtain scale, you have to have a certain amount of standardization. You also need a certain amount of legal security of what you are actually buying, and hence the task force was also looking into standardizing trading contracts and also standardizing the way that the rules that are the legal underpinnings of standard setters themselves, or are aiming to standardize that. But probably the most important thing is indeed this credit level integrity part, which is this meta or threshold standard that sits above all of the standard setters in the market today, with the aim to standardize and improve quality. So the way that is meant to work is the following. So we'll have this new body on the left, which is coming in, the Integrity Council for Voluntary Carbon Markets, which is going to interact with and verifying bodies, or essentially auditors. And the way the system works is the following. So it's kind of a three-layered system, where the first layer is a standard level core carbon principle, or CCP. And the standard level CCP essentially says, based on a certain rule book and what you have provided us, you 20 standard setters, we either assess you as good enough, or here is some feedback on what you have to do in order to kind of come back next year to be part of the system. But then it goes one level deeper, and it says for all of the standard setters that are approved and are in, it does not mean that all of your carbon credits are in. So there's a second level screening with a detailed set of rules for each methodology type. And that those could be concrete rules for forestry projects, concrete rules for cookstove projects, etc. And if those rules are not being met, then that part, even though the standard setter is in, potentially half of their portfolio of credits may not be part of the CCP system. And thirdly, setting a requirement for a set of additional attributes. This is essentially just standardizing the data that each standard setter has to provide. So there are certain things like whether a credit is an avoidance and reduction credit, or whether it is a removal credit, which is becoming very critical for achieving certain corporate claims versus others, and it's a very critical distinction. Other critical distinctions as whether the permanence of the storage is like a 30-year storage, or nature-based 30-year storage, or is it a likely 100 to 1,000 years geological storage. It's not a critical dimension. And these, we want to make sure that all CCP credits, they clearly mark out exactly these critical components. So that's how this system has been set up to work. I'm gonna deep dive a little bit. Gonna get quite into the detail on some of this stuff. Here you will see the highest level of what these core carbon principles are about. So you have a set of credit level principles that are looking at things like whether the credit is permanent, whether it is additional, e.g. This action, whatever the action was, would not have happened if it wasn't for voluntary carbon market credit or voluntary carbon market financing. Whether leakage is accounted for. Essentially, if you protect one area, you might be displacing negative action to another place, and how is that being taken into consideration? Only counted once, of course, is important. Then you have a set of operational principles on how the standard operates itself. So having a solid legal underpinning, having a publicly accessible registry are important dimensions there. And for each of these things, they break down even further into a very detailed and complex system, of course. So you see all of the things we just talked about, like additional, monitored, permanent, they break down further. And of course, behind that, there are detailed definitions again. But what I wanted to bring to you today, because I think it's probably of particular interest for any forestry focused group, is baseline setting. Probably the most controversial topic when it comes to forestry carbon credits. And let me just set the scene a little bit on that. It's essentially very, very difficult to understand how to set a baseline for any given forestry project, because you're essentially never sure what would have happened in case the carbon credit financing was not there. So you always have this dilemma that you will never be able to actually understand what would have happened. And for this reason, there's a huge degree of variation between standard setters. Some are outright excluding what's named as project-based REDD+ credits. Others take a different approach, and they say, look, we're just gonna set standardized baselines as a standard. So if you're in this region, that's what the baseline is, and that's sort of set centrally. Or others, again, have a different approach of providing safeguards, and this could be having baseline setting within approved reference levels set by jurisdictions. So there's a national set forest level reference level of how fast deforestation is happening, and everyone just has to match up to that. Another huge debate here is whether this should even be allowed at a sort of project level and a private area type level, or whether this needs to happen at a country or jurisdictional level. So that's probably the biggest debate, where essentially, if you do this at the jurisdictional level, the theory goes, it's of course a lot bigger area. You have a lot less chance of leakage of essentially illegal loggers going to another place in the country. But on the flip side, you have another argument that says many of the countries where these activities are happening, you may actually be facing a more difficult time, perhaps corrupt governments, etc., that makes it worse potentially for the population to have this go through the government and go through private individuals. And that is essentially this big debate that I just laid out. So I would say the market is fairly split, even I would say 50-50 on whether project-based REDD+ is a fantastic tool in order to bring financing to communities in need that actually make a difference, or if this is pure greenwash and only jurisdictional programs should be good enough to credit carbon to generate carbon credits. This is one of the big debates that are not yet solved within our task force, and which is one of the things that have been left for the future governance body to opine upon. I'd be curious to hear your opinions on this. And I think another big debate we've been back and forth on a lot in the task force is should a project, assuming we can have developer project-based REDD+, should they be able to set the baselines themselves, or do we have to figure out a way to tighten up this very possible this real issue of a perceived conflict of interest? You know, any project developer will always, very naturally, try and make the best baseline they can possibly model in order to get as many credits as possible. It's just their incentive in the way things work. So should we take that out of their hands, have either a standard setter do this at the central level, or have completely independent third parties who don't have an interest in the outcome needing to do this job? So there's a few debates left to be solved, and hence this new governance body, the Integrity Council for Voluntary Carbon Markets that I mentioned. They have a pretty big job to do in achieving their mission. Can only repeat it again. Their mission is the same as what we had on the Taskforce, figuring out how to bring high integrity carbon credits to the market in a way that is robust, transparent, and in deep liquid markets to also enable scale. And I think only the two things together is what truly makes a difference. And I think also just worth repeating, I've said it before, but I think it's just so important to repeat it again. This is not, and it should never be, in place of companies' internal decarbonization efforts. I think the task force, the ICVCM, has been extremely clear on this from the start. You have to separate the two things. You know, for a high integrity corporate strategy, you have to have a certain decarbonization pathway that you lay out and you follow, and you independently set a carbon credit strategy, ideally compensating for all your emissions with carbon credits as you're following this very ambitious decarbonization curve that you've laid out. And this is not about sort of continuing your status quo and buying voluntary carbon credits to just to compensate. Because I think that is exactly why accusations of greenwash are fraught in this market. Here's the body. Here's the body that's going to be carrying out this work. So it's a pretty complex organization with a host of founding sponsors behind it, which is fantastic. Everything from ENGOs, tech-based NGOs, finance-based institutions, business associations, data associations, academics. So a really broad set of organizations that stand behind and are pushing this body. A fantastic and diverse board with an engine room made up of 4 organizations now, which is the Green Finance Institute, is the British Standards Institute, IETA, and C2ES, who are driving this thing, with a fantastic expert panel to finish up some of those critical debates that we started discussing earlier. With it still, we have this broad range of organizations that have chosen to stay involved, and perhaps if any of you on this call afterwards would be interested to see how you can take part in this. I think there's always room to join this body and help shape its outcomes. So very happy to follow up on that. In order to help shape the 4 things which this body is trying to do, ensuring we get to the 1.5 degree ambition, actually get the core carbon principles out there in the market, provide oversight over the 20 or so standard setters that we've seen, and finally continue to drive coherence in the market by ensuring interlinkages between, recovering key interlinkages between different bodies and ensuring the whole ecosystem is pulling in the same and right direction. Just in terms of the next steps, there's of course, as you can imagine, this is not that old. It's just a couple of months old. This organization, there's a whole host of work for it to do in just getting fully operational. Everything from we've had to set the name, get chairs in place, get charters, HR model, fundraising plans, etc. But it's moving ahead, and hopefully very, very soon the body will be back in sort of back onto what it's really there to do, which is deliver on that mandate. And that was all I wanted to share. But I hope that's sparked one or two questions, and really looking forward to having a good discussion on this topics for the next 20 minutes or so.
All right, thank you very much, Erik, for your presentation. Really appreciate that. Extremely interesting. I would say it couldn't be more topical here. So we do have a host of questions that I'll just get started with. First question is on your thoughts on carbon market effectiveness relative to other interventions. So, carbon markets can contribute to, or voluntary or otherwise, but we can talk specifically voluntary, can contribute to net emissions reductions. But is that, how does that compare to the potential reductions coming from a carbon tax, say, or a compliance market? Should this be where we are investing our energy here?
Obviously, I'm vested in the voluntary carbon market, but I think you also just need to be humble, right? Those other interventions, government interventions, are absolutely, outsized more important than the voluntary carbon markets. Carbon taxes, and in particular, cap and trade ETS systems, I would say have a much stronger overall effect than voluntary carbon markets. It's great to also see the scale up there, right? We're now actually at 22% of global emissions that are covered by cap and trade and ETS systems, which is great. But there's plenty. There's still a huge chunk that is not, right. And while that continues to remain the case, I think it's important. There's a solution for the remaining 80, as long as they are not covered by compliance.
And so, linked to that question, we have some others that are related. So would these proposed initiatives that should impact the voluntary carbon market, do you see, so the proposed governance body, for instance, would that further encourage compliance markets, do you think? And could compliance markets be assessed by a similar or the same governing body in the same way? Go to a place where compliance and voluntary fall under the same umbrella?
That's a good question. That is a good question. First of all, maybe it's like taking one step back and just talking about the interlinkages between voluntary and compliance markets overall. So there's at least sort of four broad interlinkages that we see already today. One is for most of the world's cap and trade ETS systems, there is actually a certain quota that can be filled with voluntary carbon markets, with voluntary carbon credits. Usually 4 to 10% can actually be filled not with quotas or allowances, but really with carbon credits. Interestingly enough, not anymore Europe. Europe stopped this, but pretty much everywhere else in the world, that's still allowed. I think secondly, in carbon taxes themselves, you do now have a few innovative countries that are putting together systems where you can actually offset part of your carbon tax using voluntary carbon credits. Third, you have large industry compliance schemes such as the CORSIA scheme. So that's a mandated scheme, but it's fully reliant. It's 100% reliant on voluntary carbon credits, and hence, an example of compliance, directly creating a demand signal for the voluntary carbon market. And fourth, country schemes that you see popping up, for example, in UK and Netherlands, where the government actually buys up certain credits under certain circumstances. So these things are very, very interlinked, but there's probably a long, I think, a long runway until these things will be connected on the governance level. It's really a very, very different set of individuals and ideas that are happening here. So you have everything that's Article 6 being negotiated here in COP as we speak, which is all about UNFCCC, national governments, and what we're talking about with the Integrity Council for Voluntary Carbon Markets is a set of private individuals uniquely who are just aiming to fill the gap while compliance takes its time to fully ramp up. So that's that. I think that's today. If we take 5 years down the road, if this voluntary body is really successful, if it's truly opine upon high quality credits, is there a world where these two things come closer and closer together also on the governance perspective? Would be very interesting, but that's probably a long time away.
Here's what I found.
Similar question. So you talk a little bit about the overlap with carbon tax and some interlinkage there, but do you expect that carbon markets and carbon tax schemes in general are mostly mutually exclusive? Does that create problems for additionality if you have a carbon tax in place, as well as how does that complicate calculation of additionality, and can you have both systems in place?
I think you can. I don't think. So I think my opinion is there's not an inherent conflict there. So I think as long as the rules are sort of well outlined up front, and it should not be about again within certain percentages, as a load balancing mechanism. I don't think that drives a problem. If you got to the extreme, right? Like if we just take the extreme example, today a carbon credit costs about $3 a ton, which is extremely, it's ridiculously low, right? And it's ridiculously low compared to any decarbonization measure that a corporate has to take, which is why I kept saying a couple of times in the presentation, you have to link these things. You have to have a very ambitious decarbonization strategy where you're going to be paying $100 a ton, $50 a ton for your decarbonization path. But at the same time saying, we commit to that, but at the same time we're going to use the $3 a ton, the $5 a ton to compensate all the way along until we're at net zero. So to play out that analogy against your example, if the carbon tax is at $50 a ton, and you have voluntary carbon markets at 3, it's obviously a big problem if all of those 100% could be met by voluntary carbon credits, because that would just shift the market completely there. If it's 5%, then you might be actually just creating a good demand signal for project-based approaches, while ensuring the majority of the action is happening through the tax scheme as it was intended.
Thank you for that. Really, that's an interesting question and dynamic. Some questions now about pricing. So first, what impact do you expect scaling would have on prices?
We've done a lot of modeling on that. So we've done a geospatial analysis of the entire planet to understand exactly in every sort of area of the world how much potential there is for nature-based solutions, and we sort of done an overlay of that on every single sort of technology, how much potential there is beyond regulation for voluntary carbon markets to have things like renewable credits, energy efficiency credits, etc. And for each one of those solutions, we have costed them to get a very detailed bottom-up cost curve. And what we expect and what we believe is going to happen is we're actually going to run out of the cheap supply in not too long of a future. So where we're currently at $3 a ton, by the time we reach 2030, those are going to be fully used up. And obviously it's a bit out, and we do have a range, but I think we're pretty certain that you cannot deliver these things at any outside of $10 to $40 a ton by the time we reach 2030, as we will have used up the cheap stuff we have now.
So to follow on that, then, that in addition to the suggestion that plans become more rigorous, projects are going to get more expensive. Do you believe that, if we're talking about the voluntary, do you believe buyers pay those prices?
If buyers will, so let's assume, so I guess it's the question, if we're now at $30 or $40 a ton in 2030, if buyers will still want to be paying for those things. I think they don't really have, I don't think they have a choice if they stick to their commitments, right? So what buyers will be faced with increasingly is that the cost of their decarbonization measures and the cost of the carbon credits will at least to a certain degree converge. I don't think they're ever going to meet, but they're going to increasingly converge. And if you're committed to net zero, and if you're committed to being carbon neutral on the whole trajectory from today until reaching net zero, then I do think at least a fair amount of the companies that are committing today will find ways to stick to that. And I think we're still talking, even if we're talking a 10x price increase from today, it should be doable within sort of, if you look at global profit margins of firms, that would take a dent, but it's not an impossible thing to get through.
Another question, thank you for this, on prices. So how do you expect regulated carbon credits coming from compliance market impact current, future prices of the voluntary market? Is the relationship general prices in those two markets? And similarly, what is the relationship between carbon tax and the price? It's usually reinforcing, positively correlated, negatively correlated.
Kali, unfortunately, half the question I got lost. I think if you wouldn't mind taking that one again, would be really helpful.
Sorry. The question was again on prices and looking at the compliance market and carbon taxes as well. What impact do these other markets and initiatives regarding carbon pricing have on the voluntary market pricing? So if we see an increase in compliance prices, do you expect voluntary credits to go up in line, or is there a positively or negatively correlated? There is the question.
Got it. I think today is pretty uncorrelated. So you have the price of voluntary carbon credits, which is mostly being determined by the underlying cost of developing those projects, which we know today is around $3 a ton, but it's going to increase to like 4, 5, 6 over the coming years and onwards. But it's really driven by like on the ground, like how much does it cost to protect this area of land? How much does it cost to implement this cook stove? That's what's driving the price for these things. Whereas the EU ETS system, it is driven completely by the will of the EU Parliament in any given year. So there's just like the underlying cost of what is the price driver is just completely different. like very limited correlation. I think if we look again, like maybe like 5 or maybe 10 years ahead, there may be some convergence that we'll see as probably more and more countries will think about these, they will think about the opportunities for, the $5 a ton opportunity that's out there. A country may want to just actually do that opportunity themselves in order to have that count towards their NDC, rather than allowing that thing to happen in the voluntary carbon market. And hence, if countries are going into these cheaper, biggest bang for the buck opportunities, it sort of might drive a convergence in the very long term. But I would definitely wouldn't try and set up a correlating tracker today. And even if you try and look at compliance like if you look at compliance, in some countries you have carbon tax at $1 a ton. In some countries you have $120 a ton. So it's just a complete spread and spectrum of where carbon prices are today.
Sorry, more questions here, trying to keep track of them all. Okay, one question, again related to the supply and demand pricing things is, so we see on one of your slides, there was a lot of unsold credits, increased issuances, and they're still unsold, right? They're just there on the market. And yet there's a lot of talk about increasing demand. So what is all of this talk of increasing demand just a bunch of pledges that people aren't actually buying it, or how do we have so many unsold credits with this rapidly increasing demand?
Good point. So today, like well observed on the chart, indeed there's about 3 times the current actual demand of just leftover credits in the market that no one has bought. Now, in the sort of immediate perspective, that's of course a very, very demand constrained market. But I think if we look at the expected trajectory, if we look at sort of the 1,000 biggest companies in the world and what they've committed to, and how that's going to come online over the next few years, and if those companies are holding to what they're saying, then that 300 megatons of overhang would be used up very quickly. So it wouldn't be sort of a long, it's not a long tail that we're going to see for forever in this market. And I think there's also another point, which is that out of those 300 megatons, I'm guessing that 200 will never ever be bought, because they are, their time has passed, they're not seen as high enough quality, and the market has moved on, and they might just be left for the history scrapyard, hopefully.
Okay, that's interesting. So you don't see them on the market as bringing prices down necessarily. They are seen as sort of a distinct product.
Does it have a certain depressing effect on prices today? Yeah, it does. I think it does. But also prices have been rising pretty fast in the last year even. So if you looked at the standard Corsia contract, which I think started the year at around $2.50 a ton, it has now gone above, at least last time I checked, it was way above 5. So even in the last year, you've seen big increases in prices already. So I think it's a sign. I think it's a signal that a lot of those credits are not going to be bought.
Some questions here on, let's say, more actors, and so regarding the governance, this proposed structure, umbrella body to regulate the voluntary carbon market, politically, is this something that's likely to happen? Is this a realistic proposal? And would you suggest that it would be hosted within an existing international body or developed on its own? And related question is, are there countries entertaining this same approach, right? Saying at the country level, we're going to have the government regulate the voluntary carbon market.
Yeah, yeah. Look, given all the time that I've personally invested into this governance body, I really do hope it will fly. But and I think the reasons why I hope that it might eventually indeed succeed is probably a combination of the following things. One is that it really has very broad-based membership, and it really represents kind of like every part of the value chain. It represents suppliers, intermediaries, standard setters, buyers, financiers, and ENGOs, who are all sort of in the tent and trying to make this happen together. I think that's very much reflected also in its board, which has been incredibly carefully put together to represent every part of the globe, to represent every sort of different type of market expertise, etc. So it's the members, it's the key people, but eventually it will also be about the quality of what it produces, right? So I think it will only really get legitimacy once it has a finished product out there, and hopefully it lives up to those environmental guardrails that it has set out to fix. And I think that will be the real test of its validity. When it comes to the second part of the question on what governments are doing, I think you do see a few countries that set up their own their own government standard for voluntary carbon markets. So you have Australia has that. We see, I think to a certain degree, the California system in the US works this way. There's probably talk of a bill coming through in the US on agricultural voluntary carbon markets, where it again would be a government-sponsored standard. So that's definitely something that we see in different places across the world, and it might also be a way forward. I actually don't think it's the right way forward, because this thing really works if it is a global market. Like the whole point is, I think, is funnel the billions to where you get the biggest bang for the buck. That's sort of the underlying philosophy. And if you're going to constrain yourself to intranational markets, then you lose that effect.
All right, similar type of actors structure question: who opposes it? Where's the pushback? What are there any types of actors who are expected to lose from this initiative, or for the status quo?
Yeah, Kali, we had today Greta Thunberg wrote a very angry tweet against the body. So I think the Greenpeace is very opposed. A couple of the more extreme ENGOs are opposed. I would say if you look at an ENGO space in overall, you probably have 60 to 70% who are actually on board that voluntary carbon markets have an important role to play, and you have 30% who are vehemently opposing it, and doing so very publicly. And I can understand their fear. I can fully understand also the perspective they're coming from, because I think that there has been stories in the past and there's continuous stories today where this market is not working properly, or you have people just buying these things in order to continue, to drive a story while continuing their status quo emissions, while not buying high enough quality carbon credits that actually do what they say they're gonna, that say, actually have the environmental impact they claim on the certificate. So I get the criticism, and they don't have faith it can be done right, but I do, and I hope this governance body will will prove that point over the coming years?
So this governance body and associate proposals will make, it seems, having a certified credit more onerous, right? You have stricter standards will be harder to achieve. Do you expect that will have a restricting effect on the number of projects we see out there? Just not enough, or I guess if prices are going up, will the opposite happen? And related to that question, do you think the type of landowner who might be able to participate is going to change? Already we see inequalities in the types of landowners who are able to engage in the carbon market to produce carbon credits. Smaller landowners being to some degree left out relatively. Do you think that will become even more the case with stricter standards? Something that Taskforce talked about.
It's a good point. It's really good question. Really good questions. I mean, I think the first one just has to be a resounding yes, right? That if the whole point of this thing has to be to screen out a big chunk of the credits in the market today that are not good enough quality. Like I mentioned, those 300 gigatons overhang. I kind of hope that the answer is something like 150 to 200 of those get screened out by the new rules. Then comes an interesting secondary question of that, right? Which is what's the impact? What's the social impact of this thing? And I think that's actually like it's a pretty fundamental debate and question in this market, which is you're anyways probably doing something quite great with voluntary carbon markets, which is you're funneling billions of dollars from rich global north companies to landowners primarily in the global south, for whom this is a fantastic additional revenue stream, and it helps. It's also a very good driver of social equalization. But I think the only problem is can't be at the expense of environmental integrity. And if you come, like even if that's a great side benefit, if it allows a company to claim it has done something which didn't really happen on the environmental side, then you're still not really helping yourself, because you don't have a system that has kind of the integrity to truly scale. So you're probably going to, if you don't take that hard decision now, you're probably going to keep on being in a system where you just get attacked for not doing the right thing on climate. And hence you don't move the whole, so you don't actually release less overall billions in the system. You will hopefully get more overall billions flowing through if you make hard decisions on integrity today.
We're unfortunately at time, and I have a series of very interesting questions that folks have posed here. But I'll just very quickly, a very quick last question. You're at COP26 now. What do you hope to come out of this regarding carbon markets? What's at stake here? What should we be all looking out for from a carbon market perspective?
Yeah, I mean, look, I'm sort of cautiously optimistic that there might be some breakthrough on the Article 6 of the Paris Agreement, which has so far wasn't approved in Paris and hasn't been approved since. Which was it to come through, would provide more clarity on how these markets function going forward, and provide more clarity between how the interlinkages between states and voluntary carbon markets will function. That might cause a big disruption for the voluntary carbon markets for a little bit, but sort of getting that clarity and focus to allow sort of the whole system to sort of move forward and under clear international rules, I think would be a huge breakthrough in the long term.
All right, well, thank you.
Cautiously optimistic.
Thank you so much for your presentation and for these questions. I apologize to those whose questions I was not able to ask. We do about, as I say, a host over here, questions that we'd love to discuss more, but there you are, time limits, and I'll So thank you, Erik, for your presentation and for being here. Thank you to everybody for coming, and have a happy evening or morning or afternoon, depending on depending on where you are.
And thank you so much for having me. It's been a real pleasure.
Bye.